US CPI defies expectations, but will it sway the Fed? US consumer prices were unexpectedly unchanged in May as cheaper gasoline offset higher costs for rental housing. But inflation still looks high for the Federal Reserve to start cutting rates before September, and perhaps even in September, against the backdrop of a persistently strong labour market. Well, with me is Andy Schneider, senior US economist at BNP Paribas. Welcome, Andy. So a flat month-on-month reading in May CPI and a smaller rise in the core rate than expected. What are the main drivers in today's numbers?
So absolutely a solid downside surprise in CPI inflation. I note that on the core, even though we got a rounded 0.2, unrounded, we were at about 0.16. So a strong downside surprise. And when you look at the details, the surprise wasn't in goods. That was actually flat. It wasn't in shelter. It was in that really important, especially for the Fed, non-shelter services inflation category. So that's really what the Fed would want to see. So I would say, just based on that high-level view, this is one of the better, more encouraging downside surprises that you can get.
Now, in your notes, you argue that the process of disinflation, much of which is down to improved supply chains, may not be over yet. So can inflation take another big leg lower still?
And that's a great question. And I will say, just a caveat, this is the kind of downside surprise you want to get. But looking a little bit deeper into some of the details, there was still some noise here. So specifically, airfares was very negative. And then I think the one that stands out most to me, motor vehicle insurance, after just months and months of very strong prints, was essentially flat for the month. So that swing from just those two categories was almost 0.1 of a percentage point. So it tempers a little bit of how great this report looked. And I think when we think about inflation going forward, look, the direction of travel is definitely still down. But I think that it might still be a little bit of a gradual process in the sense that if you look at the core non-shelter services, excluding those airfares, excluding motor vehicle insurance, it's still attached to wages, and there's still some process of a gradual decline in wage growth that should take a little bit more time to fully play through in service inflation. And then goods, which was flat again this month, has been relatively resilient. It's a minority of the inflation basket, but it can be a bit stronger post-pandemic than it was pre-pandemic and keep inflation relatively more resilient even as we continue to kind of travel lower through the end of the year.
So to what extent will today's reading soothe anxiety among some of the more hawkish Fed policymakers, such as Christopher Waller? He said he wants to see several months of benign inflation before being confident enough to vote for a rate cut.
Yeah, this is the type of report overall, especially with that headline non-shelter services inflation, that Fed officials will want to see. And if we just look at April, where it was actually a stronger core CPI print, Fed officials overall, they didn't say it was an amazing report, but they said it was a good report. And it was a good enough report for them to see, if they want to see several more that were similar, to start seriously considering rate cuts. So I think across the board, Fed officials are going to welcome this report. And I think for the hawks, it's really going to take out any impetus, certainly for any further rate hikes, but should even make them start to feel a little bit better about broaching the possibility of rate cuts this year. But I will say, I think the emphasis is still, especially from some of those noisy categories, airfares, motor vehicle insurance that I mentioned, that they're still going to want to see more. This has been 2 months of improvement, but they're going to want to see multiple, several, something like that, months more before they can start getting ready to lower rates.
So, Andy, does that mean we're going to have to wait until December to see a rate cut?
So we still are of the view that the first rate cut comes in December. I think it's hard to ignore the election here. And I think when we look at the evolution of the economy, our view is that inflation should continue to improve, albeit not to the degree that we saw in May on the month-on-month. Still should be a little bit stronger as we get to June, July, August, and September, but still on an improving path. And we do think the labor market is going to hold up relatively well. So if we didn't have an election, I think September can be in play. But the reality is not just about the politics of the election, but the election means potentially very divergent economic outlook. So I think as we approach the election in September and at the meeting right after the election in November, it's still hard for us to see the Fed embarking on a rate cutting cycle given the outlook being so potentially different. So we still think that the Fed holds steady through the balance of the year and we still get that first cut in December.
So what optics do you think the Fed will present in its summary of economic projections today?
So I think we're going to get a little bit of marking the market for everything. So I think just GDP growth a little bit lower, but that's just kind of citing Q1 where the headline GDP growth was relatively weak, even though that domestic demand, the spending component was strong. Unemployment rate a little bit higher. Again, we've seen the household survey has been a little bit on the weak side, unemployment rate drifting higher, even though hiring has been strong. And inflation, even with the downside surprise today, I think they're still going to mark to market some of that Q1 strength. So we think we're going to get up to 2.8% for core and headline PCE in the projections today. There's a possibility that actually comes in a little bit lower given what we saw in CPI today. But I think all of that still will tell a story that those 3-cut median that we saw in the dots in March is still probably going to move up. So we're going to get less cuts in that median, I think. Our view is that we're going to see 2 cuts for this meeting rather than 3, with a bit of a risk for 1, but I think after the inflation print today, that probably keeps us more confidently with the median moving to showing 2 cuts.
Okay, Andy, it's been great to hear your thoughts today. Andy Schneider, Senior US Economist at BNP Paribas. Many thanks for being with us. That is Market Insights. We have more videos on Reuters.com.